In 1973, ERISA came on the scene, and shortly after that was the creation of the 401k, which obviously was in conjunction with the IRA. And what that was were plans that went from away from companies doing pensions, where it was on the company's performance to make sure the retired employees got paid, to no longer doing pensions and putting all the risk on the employee. So they were able to match certain contributions, but the investment risk fell on the shoulders of the employee. Why is that important? Today's topic is a Roth IRA tax deferred, and are my Roth IRA earnings taxable? I just shared with you a little bit of a history of how 401ks were created, right? Which basically goes in with pre-tax dollars, to answer your question about a Roth. It goes in with pre-tax dollars. It's not a tax savings. It's a tax postponement or a deferral that results in substantial lost opportunity cost. There's no disability benefits, and when you take the money out, it gets taxed at ordinary income. After a while, people began to complain. They began to say, hey, listen, can't we create some kind of money or some kind of bucket that comes out tax-free? And after a while, the powers that be, whoever they are, they pull all the levers, they finally said yes. Now keep in mind, if you own your own company, an LLC, and you do a profit sharing 401k, or in this scenario, let's say a SEP or a SEP IRA and you're past 50, you could put north of $50,000 a year into these quote unquote qualified plans, which means pre-tax dollars of $53,000, $54,000, $55,000. However, if you want to do a Roth IRA, you could put about $7,000 in if you're lucky, and that includes being over 50. What does that mean? If you're making a lot of money and you're kind of forced to put 50 grand away versus 7 grand, which by the way, if you're making too much, you won't qualify. In the end, your Roth IRA does grow tax-free, and it does come out tax-free. However, there's a shell game that's not in your favor based on the menu of choices that you have when it comes to this. And then the next thing that they decided to do, they created the Roth 401k, which instead of putting 7, allowed you to put north of 18, upwards of 21 if you're over 50 years old. You know, I love these questions because it's really about getting educated. You have an alphabet soup of retirement plan: IRA, Roth IRA, simple IRA, SEP IRA, traditional IRA, 401k, 403b, 457, defined benefit, defined contribution, cash balance plan. Look at all of those different letters and numbers. And to me, I really believe it's meant to confuse you, right? So in the end, it's important that you get with the right team that can really explain to you the advantages and disadvantages of all the different financial products and alphabet soups that are out there. So all of your decisions are made understanding fees, market volatility, inflation, and interest rates, and most importantly, what does it look like from a tax perspective? To answer your question, Roth IRA grows tax-free, comes back tax-free, right? So it's not tax deferred. And it's important that you understand now, when you think about 20, 30 years from now, maybe even 40, to be able to be fully balanced. So when you're in that wealth distribution phase of your life, you're not fully exposed to taxes, and you're nimble, and you can make maneuvers and strategies based on distributions of products because you understand their advantages and at the same time their disadvantages. Anyway, every single day we're pushing out content, we're bringing new information. We would love for you to hit that subscribe button equally as much as we would love for you to add comments, questions, and one of the team members will get back to you if you really want to sit down and talk about it.